Hello and welcome everyone to our Menino and ABB co-hosted webinar. I know you guys are very excited about the content we're going to present. Our goal for today is to educate you all on the PPP forgiveness and answer questions about the implications of the Flexibility Act. Before we get started, we're going to go through a couple of housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the red, orange arrow buttons. During the webinar, we also encourage you to ask questions. We ask you to hold on to those questions till the Q&A session, as most of the questions may be addressed during the course of the webinar. Well, how do you ask the questions? Well, in the webinar pane, you'll see a questions box that you can use to type your questions in and click submit. Again, our presenters will answer those questions as time allows during the Q&A section at the end of the presentation.
I think somebody's computer's on.
Yeah, I'm trying to mute the thing. Sorry about that. I'll put my thing on mute.
All right, there we go. Apologies for the technical issues. All right, and then before we get into the presentation, I have one more thing to mention. For good audio quality, please check your settings to ensure the appropriate audio option is selected. We don't have a dial-in option, so please make sure your computer audio option is selected. And also, a link to the deck and the recording will be available 48 hours after the webinar. All right, so for today's presenters, we have Leon Blankstein, who's the president and CEO of ABB. We have Steve Peel, who's the regional executive vice president and SBA department manager of ABB. From our Menino side, we have John Schweisberger, who's business outsourcing services partner at our Menino. And then we have Jen McCabe, who's also a partner of the business outsourcing services team at our Menino. So with that, I'm going to hand it over to Leon.
Thank you. Good afternoon, everybody. I'm Leon Blankstein, President and CEO of American Business Bank. Once again, I'm pleased to welcome all of you this afternoon to the second in our series of webinars on the topic of PPP forgiveness. And we're doing it in partnership with our friends at Menino. For those of you who may not be aware, ABB has partnered with Menino, the largest CPA firm in California, to help bring you forgiveness insights, program interpretations, and hopefully some peace of mind. The guys and gals at Menino are current and familiar with every aspect of PPP, or they're getting there, forgiveness. And working together, we will do everything we can to help you be as educated a borrower as you can be, to get your questions answered and try to make the forgiveness process painless. Getting you to the finish line with the greatest amount of forgiveness possible is our priority. This whole program, honestly, has been somewhat of a moving target. If you're confused, you have a right to be. Major changes to the forgiveness program keep coming. And many of you know, or all of you know, the most recent ones were just last Friday, June the 5th. Don't worry, we'll make sure you get the assistance that you need for as long as the changes keep coming. With that, enjoy the show, and I'll turn the program over to Steve Peel, and thanks again for joining us.
Thank you, Leon. Appreciate that. Yep, definitely a lot of changes. My name is Steve Peel, and I run the SBA department at American Business Bank. I'd like to start by thanking everyone again for taking out the PPP loans and working with American Business Bank over the past couple of months, providing the necessary information. And I know we keep asking for new information. SBA keeps giving us new guidance, and we ask for more information as it comes out from you guys. So appreciate that. We also appreciate the fact that borrowers took out so many loans in an effort to save so many jobs and to help the business community get through such a difficult time. For everyone on the line, I wanted to just reiterate that banks across the country have already funded over $500 billion in PPP loans. which is substantial and is saving an awful lot of jobs. I'm also very proud of the ABB team and its leadership for continuing to work so hard funding these loans and preparing for the upcoming forgiveness phase. As Leon mentioned a couple of weeks ago, the Treasury and SBA released a loan forgiveness application. It provides some relief and flexibility compared to the original rules, and yet the form and the directions created even more questions to be answered, and a lot of those are going to be answered on the webinar today. In an effort to providing our clients with the best possible help navigating through this forgiveness, we did partner with Armanino and had our first webinar on June 3rd. And during that webinar, we fielded hundreds of questions, of which we compiled into FAQs, frequently asked questions, and those are available on our bank website. I imagine everybody on the line is aware of that. If not, please go to American Business Bank or americanbb.bank website and look for those frequently asked questions. In addition to the FAQs, we implemented an email for the borrowers to send to ABB asking for more help. And what we were taking those questions and working with Armanino to provide you more answers. Most of you know that email is pppsolutions@americanbb.bank. So what we have is we've got webinar number 2, and the experts are on the line and here to help. And I'm going to turn the webinar over to John Sweisberger, partner at Armanino, and his team. John.
Thank you, Steve. Thank you, Leon. Appreciate it. Appreciate everyone joining us for hopefully will be a pretty informative 90 minutes. We've got a lot of content we want to try to send your way today. We'll do our very best to help you understand it as we go through this process. As Leon put it, if you're confused, you have a right to be. It's an extraordinarily complicated and confusing process that our government has laid out for us. So we're going to try to lift the veil on that a little bit and help you understand. As mentioned, I'm joined by Jen McCabe as well, my partner in our business outsourcing services practice, and together we'll do our level best to get through as much of this content as we can and have you leave the day hopefully getting as many of your questions answered as we possibly can. So our plan for today is we're going to kind of walk through the major changes that came out on Friday and kind of go through a few questions on what it all means. We do want to walk you through a refresher on the forgiveness math and walk you through a pretty detailed example so you can see how it works in a more or less realistic setting. We'll talk through a little bit around the communications timeline and process of what's coming, give you a flavor of what the forgiveness documentation or the forgiveness calculation model and the forgiveness documentation requirements are. And then we've got a bunch of FAQs already ready to go on the back end, plus whatever comes in that we can get to during the course of the 90 minutes. So with that, let's jump on in and talk about the major changes to the Forgiveness Act based on what everybody knows now came out on Friday that certainly has a pretty profound impact on how this program works. And so the two biggest ones are here at the top. One is the fact that the covered period has now been extended from the original 8 weeks to 24 weeks, if you so choose, which enables a lot more people to use a lot more of the PPP money than perhaps may have been available during the 8-week process that was originally envisioned when everyone was thinking we're going to have a 1-month sick period and then a nice V-shaped recovery. Well, I think everyone knows now that's a little bit different. So that was the idea here, is to be able to enable people to ramp their businesses back up when the time is right and appropriate and still have access to use the money to the greatest extent possible, therefore driving the largest amount of forgiveness. So that was significant change number 1. And significant change number 2 was the change in the payroll threshold. We talked at length in our first webinar about this 75% threshold, and there was this notion of if you don't make it, you can still have some graduated forgiveness. They moved that down to 60%. What they put into the act and the way that it has been written is that is a cliff. But we caution very strongly with the use of the word maybe, because The actual, if you parse the words word for word, it clearly indicates that the use of the money that you spent, not the full loan amount, but the money that you spent, requires 60% or more to be used on payroll cost. That's what the act says. That's what subsequent press release guidance from the Treasury Department says. As of this morning, they are now in the process of saying, yeah, I know it's what it says. It's not really what we mean. We still think that there's going to be this need for a graduated forgiveness, kind of like what we did the first time around when it was at 75%. We shall see. As written, as we know at this instant, it is a cliff on 60% of your spent amount, not your loan amount, 60% of your spent amount to be used on payroll costs. If you'll recall, back in April and the first half of May, before they came out with the original forgiveness application, 75% was being used, and it too was written as a bright line. You have to do this. If you don't, in essence, one could construe, you're not going to be eligible for any forgiveness. Then the application came out in mid-May and they said, well, we're just kidding. We're going to do this graduated thing, and so you gross up payroll costs if you don't hit the 75% threshold. That may very well be what comes to pass here as well. There's wide expectation that that's what's out there, and it's being already reported in many cases. No, there's no cliff. No, there's no cliff. Until such time as they officially change the guidance and or come out with an application. As it's written, just as it was originally when it was 75%, as written, it was a cliff, but that changed, and we fully expect this one to as well. But just know that at the moment, that has not officially changed. Okay, so those are the two big changes, but there were some other changes, particularly as it relates to the reduction factors and being able to minimize or lessen, I should say, the impact of those safe harbor things and the reduction factors. So one is the deadline for qualifying for safe harbor in order to have jobs restored and pay restored to the level that they were at February 15th has been moved from June 30th to December 31st. That, of course, raises all kinds of other questions, which we'll talk about in a little bit. But that's a significant change, as is the next one down, where they expanded the number of exclusions, I should say, that you now have available to you as it relates to the FTE reduction factor. If you recall in our first webinar, if you were with us, in that webinar, we talked about the idea that you could remove from your FTE baseline calculation any positions for which you fired somebody for cause, they resigned and you did not replace them, or they asked for and received a reduced number of hours, which we interpret to include FMLA leaves. They've now gone further and said, okay, if by December 31st, you couldn't find qualified employees to hire, or you could not restore your business to where it was because the health department, either at a federal or local level, is not allowing you to do so. For example, we've got to create a bunch of social distance, and now we've got 1/3 the number of tables in our restaurant that we used to have. Don't need all the staff we used to have. If you've got those kinds of situations as well, that also enables you to reduce the baseline in your FTE reduction calculations. So they're trying to make this a little bit more beneficial for you if that is possible. And then the last two things that were of significant change, one is the payback period on new loans is no longer 2 years, it's a minimum of 5 years. Now, new loans are defined as loans that the SBA approved, gave you an SBA loan number on or after last Friday the 5th. Anything prior to that is still a 2-year note until such time as both borrower and lender agree to change it to match this 5-year term. The banks are not required to do so. And in fact, we'll talk about that here in a minute. We're actually suggesting you do not have that conversation now, but we'll come back to that. And then the last major change on the program is a very significant one, but often overlooked because everyone's so focused on PPP and forgiveness and everything. But in the original CARES Act at the end of March, Section 2302 offered this: the ability to defer your payroll tax through the end of December 2020, so the end of this calendar year, and you wouldn't have to pay that back until half of it at the end of 2021 and the other half at the end of 2022. This is effectively a minimum 12 as much as 21-month interest-free loan on the part of the federal government. There is no penalties, there's no interest, you just get to elect it. The issue was, as written in the CARES Act, this benefit went away if you had had PPP money forgiven. Until such time as it had been forgiven, you could take the deferral. But once you received notice of forgiveness, you're now back on the payroll tax clock. They took that away. So now, regardless of whether you had forgiveness or not, you may take this payroll tax deferral from now, actually from March, until the end of 2020 and not have to pay it back until end of 2021 or end of 2022, half and half. So that could be potentially very significant money for an awful lot of businesses. Okay, so those are the major changes, and as with so many things associated with this program, answers and changes beget more questions and not so many answers. So let's kind of break this down and hit kind of the hot half dozen questions that we've been getting a lot of via you and others that we speak with. So Jen, I'm going to bring you in and ask you to answer these questions. Here's the first one. Do I have a choice of something in between 8 weeks or 24 weeks, or is my covered period choice strictly binary, one or the other?
As with all of my answers, it's going to be, it depends, sadly, for many people listening, but it is clear that you can choose between 8 weeks and 24 weeks. So if you want to stick with the 8-week plan because you had a great plan for forgiveness, you can do that. If it didn't feel very good and you needed more time, you can now elect the 24 weeks. What is also interesting is they've specifically said a lot of people want to apply for forgiveness sooner, not later. They want this loan off their balance sheets, which implies that you could use all your money in 12 to 16 weeks and start the loan forgiveness application process. But we're waiting for clarification on exactly that.
All right, thank you. Let's go to the next one. We now have an option of taking 24 weeks to spend the money. I was kind of focused on being done in about 8 or 10 weeks. Since I now have 24 weeks, can I apply for more money?
The answer to that is no. Several of you have already asked that question in the sidebar. No, you have already applied for the most that you can get. Hopefully you've done your application correctly and it hasn't changed. The loan application didn't change. So you've already got the maximum amount. Plus, the banks have already sent in their bundled loan paperwork. They've gotten approval from the SBA, and that stops the clock too.
Okay, so here's a fun one. So they changed the safe harbor date from June 30th to December 31st, by which I have to have restored FTEs and salaries if I'm going to qualify for safe harbor on these reduction factors. Is that a hard and fast December 31st date or just sometime before then?
This is another question that needs to be resolved. It has been pushed back to December 31st. They have said that we can stick with the 8 weeks if we'd like to, but they didn't say that that meant June 30th still applied and that all the original loan forgiveness terms applied. And this leads us to the date that we restore our FTEs. We have always been worried about that June 30th date. Did it make sense or not? Probably not. And I don't think that they meant to say, hey, everybody in the United States of America, you must restore your FTE on June 30th at this one date. So expect clarity on this to be coming because it's likely that December 31st is going to have the same problems June 30th had. If your loan money runs out in September, say your 24 weeks ends in September, it doesn't seem likely that they're telling us that you must have everybody on your staff for the next 4 months, or you bring them back 4 months after your money runs out. So stay tuned, because the question is this a fixed date and time to restore your head count, or is it no later than the end of your covered period? We need to all understand what they mean by that.
And interestingly enough, the actual legislation says not later than, and then the application which came out said at. Well, those are two very different things. So stay tuned on that, as with so many of these things. Here's a question that maybe has a little more concrete answer to it. Number 4, how much time do I have after the end of my covered period to file for my forgiveness application?
Thankfully, this one is very clearly 10 months after the end of your covered period, whatever you elect, 8 or 24 weeks, then you have 10 months to apply for forgiveness.
Does that mean everybody should take 10 months?
I'm thinking not. I'd probably want it off my balance sheet sooner. Most people are asking us not, hey, what's the last possible date? They're asking us, how soon can I apply for forgiveness? So they've answered the easy question and not the hard one.
Right. Okay. Let's keep going here. So this longer payback term is interesting to me. Should I be asking ABB to redo my loan docs now?
The answer is no. I'm urging everyone to have patience on this. That might not be in your best interest, especially if you now have the opportunity to get more forgiven and even 100% forgiveness. They're trying to help us all out here. The bank is under no obligation to rewrite loan documents to extend that period of time. If you have a loan that you got approved before June 5th, you're still on the 2-year plan. That's a conversation that I would wait to have, and only if it really makes sense.
Okay, so Jen, this is one of your hot buttons. I know you've talked to a lot of people about this. I kind of explained the payroll tax deferral option here a minute ago, but tell me why that's such a good thing.
So the payroll tax that they defer is the employer portion of the federal Social Security. So if you're listening to me and you look at your payroll, that is 6.2% of your payroll, of your gross payroll. That is your employer portion of Social Security. That is not a covered PPP expense, okay? So you can't submit for it for forgiveness. It never had any overlapping features with the PPP to begin with. So what they've done is they've given you another avenue for that kind of relief for those employer federal taxes. That what they say here is that the tax is actually not due. It's not called a loan. What they're saying is your federal employer Social Security tax, your employer piece, is simply not due. So if you are continuing to pay it, stop it. Talk to your payroll processor, your payroll people. Don't do it. It's like you're paying a bill well before it's due. It's like you're prepaying a credit card and about 18 months in advance. So there's absolutely no need to do it. It's actually 18 or 30 months in advance. So this is a tremendous help to employers. It's cash that goes immediately in your pocket, and you can use that money to save those jobs.
Awesome. Thank you very much, Jen. That's a great explanation on that, and certainly urge everyone to take advantage of that if you can. Okay, I want to spend a little bit of time and do a refresher. We walked through the math the last time, but want to try to give you a little bit more insight on some things based on a number of the questions that we've gotten over the course of the last week or two since we started this webinar series. So let me just kind of do the basics first, and then we'll dive into some more details. So as we all know, there are 4 main categories of forgivable expense, those being payroll cost, mortgage interest, rent and lease payments, and utility payments. Together, those create your gross forgiveness amount. And then from that gross forgiveness amount, we have to do a subtraction based on the salary and hourly wage reduction factor, okay? And that's a dollar for dollar reduction against that gross forgiveness amount, okay? Now you take the result of that, multiply that by the FTE reduction quotient, and we will walk through the details on both of these reduction factors here in a little bit. But when you do that multiplication, that gives you your modified forgiveness total. That's the amount that you're actually asking for forgiveness against. Okay, so with that as a refresher baseline, Jen, can you walk us through each of those 4 categories of payroll, mortgage, rent, and utilities and kind of talk through what's in, what's out on those?
Sure thing. Okay, there's a big list here and you're all going to get a copy of this, so I won't read it to you. But in concept, in spirit, what you are to be forgiven for is gross payroll for your staff, particularly people who make $100,000 or less in a year. And on top of that, as an employer, you have other expenses. You probably pay for some retirement matching or some group health plan. Remember what I said about the employer portion of FICA not being part of this PPP forgiveness, but your employer portion of your state tax is included. And we've got a few questions on that. And depending on the state in which you are, state employer tax is usually unemployment tax. So that's why that makes sense. In some states, yes, you do have to pay state disability, but in others, state disability is paid by the employee. So you are going to have to look at your payroll journal to see what state employer tax you're paying. There are state training taxes in certain states. So look at your payroll journal, look at the state tax expense, but not the federal tax expense. You can include any sort of wage that goes on a W-2. So think about that as bonuses. Yes, you can include severance and PTO or sick leave. Those are the things that you include. Do not include, this is the part that gets a little tricky, disability insurance. That's not health insurance. That's a long-term sort of package. Or long-term care is not included here. Workers' comp is actually an insurance policy that is more like an employer insurance than an employee insurance, believe it or not. And then, of course, we get a lot of questions about union dues. In the union bill, sometimes health insurance is part of other things. It's part and parcel of other subscription services. It's just the health insurance that you would include and not the other garbage in that. Let's go to the next slide. Okay, John, are you going?
No,
I'm in.
you're covering all 4 of these.
Okay, interrupt me if I say anything wrong. Okay, mortgage interest is a forgivable expense, but the entire amount of your mortgage isn't. So what that means is there's a difference between allowable and forgivable in some portions of this. If you pay a mortgage, it is allowable to use your PPP funds, but only the interest is forgivable. And that also applies to any other equipment where you may have used the equipment and you as the collateral for your loan. The interest on that loan is forgivable. The entire payment is allowable. If you do that, if you decide to go here because you have a lot of interest on this kind of debt, you're going to have to provide your amortization schedule showing the portion that is interest. Okay, now what's not included, and this is interesting, is interest on other kinds of debt. So they really want to help you with your building and your equipment because they're trying to help you as a business operator. But that doesn't mean that they're wanting to pay interest on a line of credit. They don't want to help finance buyout payments on notes to former partners. Some of the companies we work with have debt where they're paying long-term debt. If it's not for your business, it's not something that's helping you operate your business, they're not interested in helping you out with that. Think of it that way. Okay, so remember I said they wanted to help with business equipment. What's interesting is that if you have rent or lease, and I'm comparing that to a mortgage or debt on your business equipment that you financed and used collateral for, the difference here is rent is 100% allowable and forgivable, both. A lease payment on business equipment is a 100% allowable and forgivable expense. Again, you do need to show evidence of the lease payment. You need to have backup for it, and you need to have that schedule and show that you had that lease before the pandemic, before February 15th, and that you didn't just suddenly go out and lease a bunch of equipment because you've got the PPP money now. So in sum, you can include rent. Remember, if you have a storage shed, storage locker, and you have a rental agreement for that locker, if you attach that rental agreement to your PPP forgiveness documentation, that will be included too. It's not just office rent, it's rent of space that you use for your business. If you lease equipment, if you lease a copier, lots of folks lease copiers and office equipment, those can be included. Now, if you get a bill for your rent and it includes what we call common area maintenance or CAM, you're going to have to, if it's itemized on that bill, it'll be very obvious to you. You cannot include the property tax, insurance, maintenance, gardening, plant watering, any of that stuff. It is really just the rent that you would include. And remember, this is not for new stuff. This is not to help you build a business. This is to help you save a business that already existed before February 15th. So everything that you put in for forgiveness on, you're going to have to show that it was your standard operating procedure before February 15th and that you haven't invented new ways to pay bills since then. Okay, this one gets a little tricky and you would think it was super straightforward, and I've got questions from y'all in my side panel already. Utilities are your standard utilities, gas, water, and electric, but they have also included internet access as a utility and telephone. And that's important. A lot of us spend a lot of money for internet access and for telephone. We get questions. Can I include my cell phone? I've just started paying all my employees for their cell phones because I sent them to work from home. My answer is very clearly no, if it just became a brand new utility that you paid post-pandemic. But if you have a handbook that indicates that you always reimbursed employees for the cost of using their cell phone, yes, you can include it if it was your standard practice. Now, what's funny here is they have the word transportation. And we get asked constantly what that means. There is an interim guidance that was released on April 14th. It's named something crazy, but look for April 14th. And in there, they state that transportation costs are fuel for fleet vehicles. And that's really the only thing that they've been clear about. Nothing else is clear. So I would not encourage you to push the envelope here and say, I think parking is includable, or maybe taxi fare is includable. They haven't said that. And because this is a smaller part of what they want you to spend the money on, I wouldn't push the envelope here. I'd focus on spending my money on payroll and the other things that are very clear. The entire payment is forgivable here. And once again, you have to prove that you had these bills before February 15th and that they aren't just a new thing that you're doing now. Okay, I've got this handy checklist for you. And when you get your copy of the deck, that chart on the bottom should help you. Okay, John,
yeah.
Go for it.
Perfect. Thanks, Jen. So that's the basic refresher, those four categories. And we, as Jen said, get a lot of questions. I think several pages of the FAQ library is dedicated to what's in and what's out, what can I include, what can I not include. So hopefully we've helped to clarify that a little bit. So those, as we said, together add up to your gross forgiveness amount, and then that takes us into the salary and hourly wage reduction factor, okay? So there are kind of three main steps involved in this salary and wage reduction factor. The first is figuring out who needs to be included in the reduction factor calculation and who can be excluded. So the inclusion here is any employee who had under $100,000 in pay on an annualized basis in every single pay period in 2019, they're included in this calculation. If they got paid a bonus and that you take that one pay period and annualize it and it puts them over $100,000, had you maintained that level of pay, they're out of the equation. So it's only those that every single pay period would have fallen under that $100,000 limit, which is $1,923 per week if you pay weekly and multiply it up from there. You also include in this calculation any employee, regardless of pay, whom you hired in 2020. Okay, so it's the 2019 under 100K people and the 2020 people under or over 100K, just to make it complicated. Okay, once you know who's in and who's out, then we go to the actual calculation itself. And for those who are still in the game, that is where you take a look at their average salary and wages during the covered period, whatever that time period is for you. Compare that to the first quarter of 2020. And if there was a reduction of more than 25% for any single employee, then they're going to end up driving a reduction for you. So first, did anybody fall below that? So put another way, did they get paid less than 75% of their Q1 average? Could be a problem if you had some bonuses that you paid at year end in the first month of January. That might create some issues. So be very, very aware and careful of this, because we're looking at the average during the covered period against the average for the entire first quarter. It does not distinguish between regular comp and bonus. It doesn't distinguish between overtime comp and standard hourly wage. It's total comp on average in the two different periods, okay? If you do have any employee fall below that threshold, then we move on to step 3 for those people only, and we have to calculate what the reduction is. And what we do here is we take the amount that is beyond that 25% reduction threshold. So if they were reduced by 30%, you don't have to calculate 30%, you only have to calculate 5%, the amount beyond the 25% reduction. So in essence, you get a free pass up to a 25% reduction. Then it starts to hit you. And you have to calculate this at the individual employee level. Now, here's a sneak peek at what's coming down the road. You don't actually have to do that calculation. You don't have to do any of those things. The model that you're going to be working with does all this for you. We want you to understand it because these reduction factors are very significant in terms of the impact that they can have to your gross forgiveness amount. But you don't have to sit here and try to figure out all of those things. So just a sneak peek of what's coming. Okay, so we subtract the salary and wage reduction dollars from the gross forgiveness amount dollars, and then we have to move to the next factor, the FTE reduction factor, which is expressed as a quotient. It's kind of the inverse of the reduction. If you reduced by 20%, your reduction quotient is 80%, since we're doing a multiplication factor here. So let's dive in on the FTE reduction quotient for a second. Okay, so this is looking at your average FTEs during the covered period and comparing it to one of 2 or possibly 3 base periods, depending on whether or not you're a seasonal employer. But assuming for the moment that most of you are not, your base periods for FTEs are the average FTEs that you had during the 3.5 months between February, 4.5 months between February 15th of 2019 and June 30th of 2019. So second half of Q1 and all of Q2 last year, or the first 2 months of this year. So obviously, since we're doing a comparison and a good number is one that's a higher percentage, you're going to want to use as your denominator a lower number. So take the lower of those 2 periods and compare that to the average number of FTEs that you had during your covered period. Whatever that percentage is becomes your reduction quotient unless it's equal to or greater, in which case it's just a 100%, there is no reduction. Note the seasonal employer option. Apparently the government believes only summertime hires are seasonal hires, so they have said you have the option, if you are a seasonal employer, which they do not define, to pick any 12-week period between May 1st and September 15th last summer. So again, not sure exactly what the definition is on seasonal employers because they've not come out with any guidance on that, but that is also one where you've got a 4.5-month period, which is roughly 22 weeks, and you get to pick any 12 within it, but I think it has to be a consecutive 12. You don't get to say, well, I'm gonna take this week and some other week and wait till I get to 12. So it's a consecutive 12-week period in those 4.5 months. Okay, so you do that math, and that comes up with your FTE reduction quotient that you apply against the numbers that you had previously. Now then, that takes us to safe harbors. So you can make those reduction factors go away in both cases, the salary and hourly wage reduction one and the FTE reduction factor, and the math is basically the same on both. So for the salary and hourly wage reduction factor, we look at those employees who had pay less than 75% of what they had in the first quarter on average, or put the other way, their reduction was more than 25%. So you calculate safe harbor employee by employee where there was a rate wage reduction factor in play. And what you look at here is what you see is the two dates here. You take the average that you were paying during this period of February 15th to April 26th and compare it to the salary or wage that was in play at February 15th. If A is less than B, then you have until December 31st to restore the salary or wage back to that February 15th level. This is where Jen was talking about earlier. What does that mean for people who opt for 8 weeks? Do they get to use the June 30th date, or are they going to basically be handcuffed for the next 6 months? Don't know yet, but as written right now, the June 30th date officially got changed to December 31st. There may be interpretation to change that. If you restore by then, great, safe harbor, you can throw away that hourly wage reduction factor. If you do not have safe harbor available to you, and you have to take the reduction factor. Very important note on this, and it applies to the FTE reduction factor as well. The period that you are comparing is that period prescribed as the 2 months and 11 days between February 15th and April 26th of this year, 100% completely independent of your covered period. Your covered period might start May 3rd, it might start April 13th. Doesn't matter. This safe harbor has nothing whatsoever to do with your covered period. Okay. Don't know why they built it that way, but that's what they built it as. So those were the important dates, Feb 15 to April 26th compared to Feb 15 as it relates to safe harbor. Okay, and as I said, FTE reduction harbor works the same way. You just don't do it on an individual FTE level. You do it at the aggregate FTE count of the business. Same dates, same process. Restore your FTEs to the February 15th level by December 31st. You've got safe harbor, and that reduction quotient goes away. If not, you don't have safe harbor, and you have to do the math basically to do the reduction factor. And again, as I said earlier, the model will do all this for you. You don't have to figure all this stuff out. I just want you to understand it. Okay, so that kind of walks through the refresher, but we had a number of people who wanted a little bit more in-depth examples when we did our webinar last. So I'm going to walk you through something that I'm going to acknowledge on the front end is going to be a little bit difficult for people on smaller screens probably to be able to see. Fortunately, you'll have access to the deck and the recording when you can see it on a little bit larger screen, but this is kind of the math that the process every borrower will go through is what it looks like. So we're back to our friends at ABC Company, and here we've got the beginnings of what they have as far as an employee base. So if you can hit the next build here, Sarah, so we can talk to it. Great, now everybody can see what I'm talking about. Okay, so you've got a handful of employees here, 8 employees, 2 managers, 1 senior executive, and the owner, and they're all paid a salary that you can see in 2019. A few of them got a bonus mid-year. So that all worked into the column called 2019 per month average, which came to $80,000, which is what drove the $200,000 loan you see at the top of the column. On a per pay period basis, though, it's a little bit lower because of those bonuses. So there you go, and that's what they are paid every period during the first quarter of 2020. Okay, so they got their check, their funds on April 14th. Fast forward 8 weeks, their covered period ended 2 days ago. Great. Okay, so let's go through the math for ABC Company. Let's go to the next slide, Sarah. Okay, so here's what happened in ABC Company. They did a layoff and cut pay at April 1st when things got really, really bad, and it looked pretty bleak for ABC Company. So you can see that the owner and their senior executive took a 50% pay cut. Several other managers took 20% pay cuts, and some of the junior staff ended up with a 30% pay cut, plus a couple of layoffs and a furlough. So now you can see their paychecks on a semi-monthly basis going forward at April 15th, April 30th, the 2 pay periods in May, and they kept everything at that level. So you can see the impact between 2020 Q1, where, for example, owner being paid $10,000 per pay period, now being cut to $5,000, and so on down the line. Business started to look a little bit better at the beginning of June, so last week they did a partial reinstatement. They rehired the person that they furloughed. They put them at 80% of the pay they'd been at. They didn't change any of the more senior people's pay. They kept those at the reduced levels, but the more junior people whom they'd cut 30%, they actually said, we're gonna take that from a 30% cut to a 20% cut. So we're gonna essentially give you a 10% hike on your pay going forward. And they also tried to rehire employee 4, who they'd laid off, but that person said, yeah, thanks, but no thanks. I'm going to stay on unemployment, or I found another job, but they basically said not happening and refused the offer to come back. That becomes significant later on. So then you see the June 15th payroll. You see how the 18,900 jumped up a little bit to 22,550 because of some of those pay hikes and rehires, and continued then on to the end of the month. But remember, their covered period ended on Monday, June 8th. Okay, so that's a fairly plausible situation. Now let's extend it a little bit further and start to figure out these reduction factors. Okay, so we're going to start on the salary and wage reduction factor and figure out, okay, who's included and who's excluded, or for purposes of the Schedule A worksheet, who goes into Table 1 of the Schedule A worksheet. And this is where we have to do the look back to every pay period in 2019. And remember what we said, anybody who got an annualized pay over $100,000 in any single pay period in 2019 comes out of Table 1, comes out of the salary wage reduction. So we calculated what the actual maximum pay in any period was on an annualized basis. And you can see that exec 1 here, who got paid $5,500 a pay period in 2019, also got an $18,000 bonus in their June 30th check a year ago. Well, 23,500 times their 24 pay periods makes for a large amount of money. That's a whole lot more than 100. They're very clearly out. But so too is employee 2, okay, EE2, who got paid $54,000 in 2019, $2,250 per pay period, but also got a $6,000 bonus on June 30th. So in that one pay period, their pay was $8,250, which annualizes times 24 to almost 200 grand. Even though they only got paid 60,000, they're out of the equation. Okay, so everybody that's got 5 digits in the max PP column gets a yes next to them in the include in the reduction factor calculation. Okay, so now we have to do, go back, I'm not done yet. Now we have to do the actual wage reduction calculations, and there's a whole bunch of stuff to it, but basically it comes down to what's the reduction percent. Remember, if their reduction was less than 25%, or in the inverse, they're paid more than 75% of their baseline average, then you don't have to calculate the reduction. So you can see that employee 3 had an 80% pay level in the covered period compared to their first quarter average. That doesn't meet the 75% test. You do not have to calculate a reduction there. But for the 4 employees, 5, 6, 7, and 8, each of them fell just below. Remember, they got a 10% hike, but they got it right at the end of the covered period. They got it with a week to go. So that boosted them from a 70% pay to 72% on average, which means they fell below that 75% threshold. And so they need to have their reduction calculated. And remember, it's just the difference between the 75% and whatever they got. So it's a pretty small number on each employee. It adds up only to $827 in aggregate, but that's a number we'll come back to. Okay, so those bottom line numbers, $18,900 per payroll in April and May, that jumped up to $22,550 in June. You can see at the top now of the chart. I just took the top part off. And we are including in forgiveness the April 15th pay period, even though that's covering the first 2 weeks of April, and they got funded on April 14th, you get to include that. So yes, you can include April 15th pay. You can include, of course, April 30th, May 15th, and May 31st, all incurred and paid in the covered period. And for the mid-June, June 15th pay, remember, this is a business whose covered period ended on Monday, June 8th. They get to take 6/11ths of the number, those are the number of business working days during that pay period. So they get the 1st, 2nd, 3rd, 4th, and 5th of June and the 8th. So that's the 6 days, 6 working days out of the 11 in the pay period. So they get to take 6/11ths of that $22,550. Okay. You can also see what happened to our FTE count. Go back, I'm not done yet. You can see what happened in the FTE count last year at 12. We laid off 2 and furloughed 1. That dropped us to 9 during April and May. Then we brought 1 back, and that got us to 10 in June. Okay, so now we do the gross forgiveness amount calculation. Now you're going to notice in this first line, calculated allowable payroll amount. Owner amount is limited. Remember, there is a cap of $15,385 per year under the 8-week scenario, $3,846 per 2 weeks on a semi-monthly basis. It's a little bit different, but basically we had to limit the pay to that individual during those months. Because remember, there was a $240,000 person originally who took a 50% pay cut. They were getting paid at the $120,000 level. So we have to bring down the amount a little bit to get them under that $100,000 level. So that's why you see a difference between the $18,900 we actually paid in April and May pay periods and the $17,746 that you see as calculated allowable. Okay, so that's a reduction that has to get put in place. You can also see they paid health insurance at the end of April and the end of May. They, in the middle of the month, do their 401k matches. They also had rent and utilities. You add it all up and you can see that they spent for forgiveness sum of money, what you see in bold at the bottom here, $23,746, $42,746, and so on across. Okay, now Sarah, the next click takes those numbers and rolls that into your total forgivable spend of $148,382. Recall a couple of minutes ago where we walked through that salary and wage reduction. We said there was a little bit of a reduction. It added up to an $827 reduction. That's what you see dropped in here, which brings your intermediate level down from 148 and change to 147.5. Now, that's when we have to apply the FTE reduction quotient. Remember, our FTEs on average in our baseline, our choice of either the first 2 months of 2020 when it was 12 or the middle of 2019 when it was also 12, says our average FTEs in our baseline is 12. However, recall that we had 1 employee who we laid off at April 1st, and then at June 1st tried to rehire them and they refused the rehire. Great. They come out of the equation now. So you can exclude from your baseline that one role, which really changes your baseline from 12 to 11. Our average FTEs in the covered period turned out to be 9.2 when we round it. So you take the 9.2, divide by 11, the 12 minus 1, and that's going to give you your 83% FTE reduction quotient. So at the end of the day, you multiply that by your intermediate amount of 147, which gives you at the very bottom of the page your final forgiveness amount of 122,738, despite the fact that they spent nearly 150 on forgivable spend items, and even a little bit more than that when you factor in all of the payroll that they spent. So they're going to owe still $77,262, if I'm doing math in my head right, again, of that 200,000 that they took out. That's what they're going to owe back. Okay, so it's really detailed, and I know that was a lot to go through, but I'm hoping when you go through and look at this again, you can kind of follow all the math and go, yeah, okay, I'm beginning to understand how this thing all works. Okay, so hopefully that is a little bit more helpful on that, and it's certainly not the last we're going to be going through examples. So Mike, I'm gonna look to you to kind of walk through a little bit of what people should expect to be coming their way here over the next few weeks.
No problem. Thanks, John. So just want to communicate a little bit with you about how we, in fact, will be communicating, as it were, with you in the coming weeks. So expect, and you'll get an update on this, but expect in about 2 weeks another webinar that will, accompany any training materials and directions you'll get with your opportunity to complete your application. And so with one caveat is that if the government should change any of the rules, we'll then pivot and regroup, but also then have a webinar experience to accommodate that. Second, we're updating our FAQ library twice each week. Any questions from this webinar you send in that are not addressed during the webinar, we will incorporate those questions into our FAQ library. Give us a little bit of time on that as we look at all the questions, boil it down to, or get rid of the repetitive ones, boil it down to those questions that are appropriate to add, and then incorporate that in. We will have that done by kind of the beginning of next week. But the FAQ library is currently available on the American Business Bank website. And in addition, and per the last item here on the email, the PPP solutions at americanbb.bank, that email is also in the FAQ library that's available through the website. You can send in questions, and twice a week we look and incorporate new questions into that library. And then finally, as I mentioned, you'll get in-depth process and directions and manuals with your application, and that'll could include multimedia directions, eventually manuals, and webinars. And so that's the overall communication that we have planned and will continue to do weekly. John, anything I missed there?
The only thing I'd add to that is that we are now up to about 150 FAQs on the library, and certainly I've seen a whole bunch more that have come in today. We will get to as many of those that aren't already covered in the future releases here coming up later this week and into next week, but certainly keep them coming. We want to make sure that you have answers to as many questions as we possibly can give you.
Very good. And let me just also say, and I know we said this at the beginning, within 48 hours of the end of this webinar, you will receive a copy of the webinar and also a link to the recording, so you can spend some time with it. And so we'll try to remind you of that again at the end. Thank you. Okay.
Okay. So just so you've got a sense of what's coming. So for a number of you, your 8-week covered period has ended or is about to end. We're still finalizing the process, so don't jump jump the gun yet. As we have said many times, there is no rush on forgiveness. It's not like the forgiveness money is going to run out. So we're going to go through a process here that we will walk you through here in probably the next webinar around essentially a reservation process, so that we can make sure that everyone's expectations are managed appropriately. We will also be going through the forgiveness model and having that available for download through the portal that will be opening called Teslar in early July. But that downloadable model will be available prior to the early July period, along with training. So I'm actually going to give you a flavor of that model here in just a second. But then once we get into July is when we'll be able to have all of the portal functionality ready to go. This is through a third party, so we don't have complete control over that. It's 98% there now. It may actually be available sooner than the 1st of July, but we don't want to promise something since we don't have control over that. But once we've got all of the materials uploaded from you, all your supporting documentation, including 941s and unemployment tax reports and all of the payroll reports from your providers and your evidence of payments that may have been incurred during the covered period but not paid until after the covered period. You know, a lot of those things take some time. So we don't really expect to begin having fully completed applications ready to be actually reviewed until the first part of July. That will continue on through July and August for those that have chosen to take the 8-week covered period. For those of you choosing to take the 24-week covered period, obviously this process extends well out into the fall and probably all the way to basketball season if we have one. So this will go on for a while. As we said, there's no rush. Don't feel anxiety about you're missing out on the opportunity to get forgiveness, because you won't. Okay, you've got plenty of time, as Jen mentioned earlier, up to 10 months from the end of your covered period to file for forgiveness. Certainly also, there's so many changes and clarifications that still need to be coming out that, frankly, it would be premature to try to apply for forgiveness right now based on all the different things that we still don't have answers to. So just kind of wanted to set the expectations around that for everybody. So I promised you I'd give you at least a sneak peek at the forgiveness model. This is sort of the opening page of what you would be looking at. And there's 7 tabs, but for many of you, there's only going to be probably 4 that you'll actually have to deal with besides reading the instructions on tab 0. So the first tab, tab 1, the initial data input, is basically your what I call demographic information. What's the business name? What's the address? What was the loan amount, loan date, loan number, contact information, FEIN, all those kinds of things that go into the basics of the response goes into that tab. Then the meat of it sits in tabs 2 through 7, which is where you actually enter your spend data. We are providing 2 different tabs for payroll input for some companies who have different pay cycles. They might pay their hourly people on a weekly basis and their salary people semi-monthly, for example. So we provide a second tab that if you only pay everybody on a weekly or bi-weekly basis, everybody's on the same schedule, then you won't need that second, what's called tab 3, payroll cycle 2. And I'll show you this here in just a second. If you have covered mortgage obligations, you can include that spend data on the 4th tab, the rent on tab 5, utilities tab 6, and owner's compensation goes on to tab 7, and we'll show you a sample of that here in a second as well, but those are pretty simple. So the complicated one is the pay cycle input, because this is where we have to be able to calculate all of those FTE reduction factors and salary reduction factors and look back periods, and do people qualify, do they not qualify, and do this on an individual by individual level. They made it as complicated as they possibly could for you, as we've kind of noted as we've gone through these examples. Here's where it gets good. You don't have to understand any of those calculations. You don't have to do any calculations off the model to load into the model. Like, well, how many FTEs did I really have? You don't have to figure any of that out. The model does it all. All you have to do is put in the data, the spend data by pay period. So let's go to the next tab, Sarah, and we'll give people an example of what this looks like. So this is all example data. The spreadsheet that you will get will have blanks in all of these yellow boxes, but the yellow boxes is where you put in your data. And we start by, and there's going to be, there are full instructions on this tab to show you exactly what to do. But just by way of example to kind of walk you through what looks rather daunting here at the moment. So Sarah, hit the first build, which is where we would start with what's the pay cycle frequency that we're dealing with here? Is this a weekly payroll cycle? Is it a bi-weekly, semi-monthly, or monthly? That's a drop-down menu. You just pick whichever one applies here. And then next build is you'd start to put in all of your employee names. You have to put in the last 4 digits of their social security number, and we want to have a yes, no, are they paid on an hourly basis, or essentially are they salary? If it's a no, they're salaried. If it's a yes, they're hourly. So you'd be filling that in for all of your employees. In this case, there were roughly 20 in our sample data here. And then you'd kind of start diving in on the payroll. So for each pay period going back to the beginning of 2019 through the covered period, you would be putting in the total amount that is paid in the pay period. This should all be on your payroll records. You'd put in the FTEs that was in that pay period, and you'd put in the amount, the gross pay before any deductions for each employee. Okay, because you do get to include those deductions, right? So that's why you take the gross pay. And you just do that all the way across. That's the kind of data that you're going to have to put in. But again, you've already got the payroll records, you've got this information, you're going to have to input it. It's going to be, depending on how many employees you have, a few hours to be able to do the input, but we're trying to keep this as simple as possible so you don't have to actually calculate anything. You don't actually have to understand how forgiveness works. We'll be able to get you through the process. So you put in the amounts, the dates, and you carry that on through. You'll also have to be putting in some hours data and obviously the benefits and retirement data and that kind of stuff. But I didn't want to show you all that. All this will be, as Mike said, carried out in, we'll do how-to videos that'll show you step by step through the whole thing, where you have to put in what data. But again, notice that nowhere in here did you have to calculate anything. All of this should be on your payroll records. Okay, I also said there's some other tabs. Sarah, let's go to the next slide. So as an example, covered rent or lease obligations, you can see at the top, we have a specific language on exactly what's included in covered rent or lease obligations and what's meant by incurred but not paid amounts and things like that. So we're trying to make this as clear as possible, but really all you have to worry about is the yellow boxes. Okay, in this case, here's our sample data. They paid rent twice, and they had to pay for their telephone equipment that they leased a couple of times during the covered period as well. Load that in. That's all you got to put. All right. So again, notice you've had to do no calculations. The model will do all the rest, and we will. We have complete instructions in the model. We will have how-to videos and a full manual so that for people who are kind of more visual, need to see it, we'll be able to have those arrows and those kinds of things so that you can see it. Some people like to just read it and start going step by step. So that's what's coming your way. It should be available very shortly, and we will certainly let you know once you can download it and start to play with it. Okay. So Jen, why don't you pick up here for a couple of slides and kind of walk through what people need to be worried about doing right now and what kind of documentation they're going to need to pull together.
You bet. Okay. So a lot of you are asking us, should I do 8 weeks? Should I do 24? You do need to decide. You are allowed to pick. And the way that you will indicate what you picked is when you file your loan forgiveness application. We haven't seen anything that says you have to elect it and notify someone in writing yet. I suppose they could do that, but for now, assume that when you send in your loan forgiveness application, it will be very clear what period of time you chose. And until we see that application for the 24-week period, I think that everybody should just be patient. When it comes to the PPP, we've all gotten in this habit of being in a panic, and we had to panic apply for the money, and we now have it, and we need to slow down. When you get a look, and when we all get a look at that 24-week application, it'll be a lot clearer to us that it is or is not advantageous. If it's not, you're going to proceed with the 8 weeks. If it is, you're going to wait. We're going to figure out what point in time that you have to have achieved your FTE or salary, what I call cure. So wait. For now, gather, starting immediately, the necessary documentation that you have to support that loan forgiveness application. You want it to be audit worthy, just in case you are picked and someone takes a look at it, and you want your backup, as I call it, to be very tidy so that no one says, gosh, that's a hot mess. I think I need to look at this pile. Be watching for the forgiveness calculation model that you were just peeking at with John. The reason that you don't have it this very second is that we're constantly tweaking it every time new guidance comes out. When you get it, we want it to be as close to perfect as possible, and we're really cognizant of the fact that sending it out early will just make you all do a bunch of work that you might have to do again. So we're trying to save ourselves. The next thing for you to do is to enter data as soon as you can, because there is quite a lot of data that you have to enter on these forgiveness applications. Check the ABB website often, because we're constantly feeding information back. When you ask questions, we answer them, and ABB is posting the answers to your questions. So rely on that website. That's where you go for answers. Okay, let's start thinking about what is documentation. And there are a lot of words here that you will get to read at your leisure. When you think about documentation, think about it as you would if you were preparing for an audit. So if someone came in to audit you for any reason at all, you would have to show them the bill that you paid, and you would have to indicate the date that you paid the bill, and that that bill was relative to May. So say that May is in the middle of your covered period. The bill needs to show that it was for services relative to May. Then you need to trace that through and show that you paid it. And you're going to actually need to show that it came out of the bank. So it's not going to be enough for us to say, here's a copy of my May electricity bill, and I paid it. You need to also show where that amount came out of the bank account. So you're tracing through the bill to the point at which it was paid. When it comes to payroll, it's a little more documentation, as you can imagine, because it's ultimately going to back up all of that FTE math and that salary math. So you're going to need payroll documentation to show what you paid people. It needs to show the individuals. My favorite go-to document would be your payroll journals that come out of the payroll system. Usually they also have hours for each employee. Even your salary, or what we call exempt employees, often what we like to do is put that if you get paid someone twice a month, that you paid them for 86.67 hours. So the payroll journal that is perfect is the one that has the amount that you paid everybody and also the hours that you paid everybody. It's a beautiful piece of backup. You're going to need to document individual gross comp and all of those things that the model will do for you. When you get down to showing your retirement bills and your health insurance bills, you need to be careful. Usually the employer covers part of the employee's health insurance, or maybe an employer covers 100% of the individual, but not their family. So you don't want to just give the documentation that shows your Blue Cross Blue Shield bill. you need to actually indicate next to each person how much was the employer cost. So your documentation needs to show what you actually went out of pocket, not the part that was taken out of your employee paycheck. Okay, they're also asking us for 941s, and this seems really dumb to me because a 941 covers a quarter, and the loan is either going to cover 8 weeks or 24 weeks, which certainly isn't a calendar quarter, but they want it. And this is because they're tracing it back to your payroll records. It makes a little more sense that they're asking us for our state quarterly reports. In California, the California quarterly reports list every single employee, and the gross on that report should tie to the gross pay on the 941. And then they can probably look at the names on your quarterly payroll report and verify that the names on your quarterly payroll report are actually the names on your workbook that you're filling out to submit. So they're creating a traceable trail to make sure that the people on your loan forgiveness application are the same folks that are on your 941s and your state quarterlies. This is a way for them to eliminate freelancers, 1099ers, temp payroll services, all those people who don't get a W-2 from you. They don't want them on the documents, and this is their way to audit you, okay? Let's go to the next slide. Now, for your non-payroll costs, I mentioned utilities. The rule of thumb and the words they use are that the expenses need to be incurred and paid in the covered period. That means they're trying to get you to avoid submitting for old payables that you incurred in 2019 and never paid, because that's not incurred in this period. And they also really don't want to allow prepayments. They don't want you to be using the money to pay for December costs. It needs to be incurred and paid in this period. So you want to show the bills are relative to this current period and not to January, but that they're in this period that is your loan covered period. You do need to show a bank statement, as I said, to trace through the actual cash leaving your account and paying the bill. It's not enough to have gotten the bill. You have to show that you really paid it. Now, here's a really great one. So as John mentioned, you can get an FTE exclusion from that penalty if you can show that you offered a job to someone and they refused it. So if you have tried to maintain your head count, but something happened that was out of your control, you are not going to be held to that FTE. So think about documenting leaves. When someone asks for a leave of absence, if someone is offered a job but says no, get that declination in writing. If someone resigns, get it in writing. If it's a text, take a picture of it, take the screenshot, do what you can. If an employee comes to you and says, hey, I'm stuck at home with my kids, I can't possibly work full time, I need a reduction in my work schedule, document the fact that the employee asked for it and you will not be penalized for it. Okay, now that FTE quotient that you're trying to get up to is a very important reduction factor. So this is a trick that you need to really think about in advance. Start documenting everything. For self-employed people, we get tons of questions. This is a part that's confusing. You're going to need to attach your 2019 tax return. So you're going to have to file your tax return if you're self-employed and you file a Schedule C, because the amount that you can pay yourself is based on the amount you made last year. And there is confusion right now about how much you can pay yourself per week. But for the moment, let's stick with the fact that we still think the maximum is $15,385 for an 8-week loan, which is 8 weeks out of 52 if you made $100,000 Schedule C bottom line income. So you have to attach it. Similarly, if you get a K1, you're self-employed, you don't get a W-2, you need to attach the K1, okay? And then that means that you're going to attach the owner's income statement. You're going to attach a copy of your P&L for the covered period. And they are saying that they want what you give them to match what you actually file at tax time. So get your books in order, make sure you close, as we say, that period of time. And make sure you sign and complete all of the forgiveness application documentation. I'm thinking ahead to how we all kind of miss initialing here or there on documents. Pretend you're at the Hertz car rental counter and make sure that you initial and sign every bit of the forgiveness application documentation that's required.
Yep, there are 7 certifications you have to do and sign at the bottom. So the process will walk you through all that. So hopefully this has been helpful in terms of giving you a bunch more information than perhaps you had walking into the meeting at 1 o'clock Pacific time here a little bit ago. I know there's a lot of questions. We're not going to be able certainly to get to them all because it looks like we're well into the hundreds, but we do have a handful that have come up along the way. One that I want to clarify because I know it gets confusing is the $100,000 idea when it comes to capping people's pay, but it also comes into play in those reduction factors. And we were talking about how if somebody in a reduction factor scenario made more than $100,000, you would take them out of that calculation. That is correct as it relates to the reduction factor. That does not mean that you take them out entirely from the payroll costs. You still get to take their $100,000 annualized payroll cost. It's just they use the same number in a lot of different places. So don't intermix and confuse the two because we got several questions about that. So speaking of reduction factors, Jen, we've got about 10 minutes left here. Let's hit a couple of these. The FTE reductions, Sarah, if you can load 1, 2, and 3 here, that would be great because they're all related to the FTE reduction. I did a furlough, not a layoff. Will that count against me? I had an employee resign, but I couldn't find anybody. Will that count against me? Or I had somebody that went out on disability. Will that count against me? So let's kind of hit all 3 of those real quick.
The answer is number 1 and 2. If somebody goes on disability or resigns, it's not in your control and it doesn't count against you. However, if you furloughed someone and you didn't bring them back to work, because remember, they have to be working, it will go against you. The PPP is for you to rehire those furloughed people.
Great. So no distinction between furlough and layoff. On
Right.
the salary reduction calculation, do I have to take an entire 30% cut on somebody or not?
Not, it's 5%. It's the amount over the 25% cut that you take off.
Perfect. All right. And here's an interesting one. We fired an employee during the loan period. We replaced them. That should keep our employee count constant, but do we have to take a salary reduction penalty for the people that we let go? 2 weeks into the 8, we let them go, so they got paid 25% of what they got paid in Q1. Do we have to take that as a salary reduction?
This is a complicated answer, so I won't go too deeply into it, but there's plenty of documentation that says you do not have to keep the same exact person in a job, and you should be allowed to replace them. Obviously, you need to replace them as soon as you can.
Great. Let's jump over to use of funds questions. So we funded April 29th. We did a payroll on April 30th. Do I get to include the entire payroll even though it was covering time worked outside the covered period?
Yes, the rule is paid and incurred. So you get funded the 29th, your payroll hits the 30th, you get to count it. And then at the end of your covered period, you can also include the payroll that you didn't quite pay yet. That's covered, as John mentioned, in the first couple days of the next pay cycle. You'll need to include a work paper showing those wages, and then you must pay those accrued wages on the very next pay cycle. And you have to prove that you did so.
Exactly. Let's jump into self-employed. There's a lot of questions that always come up around self-employed. We've dealt with them in the prior webinar, but in this one, what about this? Costs for employees, because they've got 1 or 2 or 3 employees, and in fact, they're actually members of their family. Can they include those costs?
Yes, absolutely. As long as they're really working, be ready to show that.
Well, there is that.
Yeah.
So this comes up a lot. The whole thing around temp agency staff are not included in the payroll costs. So I'm going to repeat that because it comes up a lot. People that you bring in as temps through an agency that the agency pays, you pay the agency pays employee, you cannot include them in payroll costs. But what about employees that we pay via a PEO?
When you use a PEO, you are considered a co-employer, and you need to get a copy of your co-employment agreement. And all of the guys out there who do this work, they know to give you that. And they can also give you a copy of your 941 because you are the payer and you are paying for benefits and you are the employer of record.
Okay, thank you. I've got a bunch of salespeople. I pay an auto allowance every pay period. Do I get to include that as a salary, as a benefit cost, or not included at all?
I would not include it. Most people are talking about it's treated like a reimbursement and it's not taxable comp, so it's not included.
So it's kind of like an expense report.
Mm-hmm.
Got it. Okay. Can I do any prepays of some of my future obligations? I want to get ahead of the curve here and use up this money.
No, the answer is no.
Okay, that's pretty clear. A lot of businesses have related entities that hold real estate outside the business entity for a variety of reasons, but they do pay rent to that related entity. Can they include that as a rent cost?
If there is a rental agreement, remember your lease is your documentation for that rent payment. And in this case, you absolutely have to have that rental agreement between those parties. Without it, if it looks like you're paying more money to the owner than the capped amount, you're going to be in trouble. So make sure you document that.
Okay, last question on use of funds. So once a week, we're paying an invoice to a company that provides us our delivery trucks and our delivery drivers. Can I include the leasing costs both for the truck and the leased employees?
Well, on this one, if it's itemized and the leased trucks are equipment that you can show you're leasing, you can include that. But you cannot include the leased, in air quotes, employees, because those employees are on a 941 and a W-2 for that company, not your company.
But the lease on the vehicle needs to be in the business's name and not in the third party's name, correct?
Yes, you're going to have to show a contract. I don't think that you'll be able to count that unless you have a contract that says they're leasing it on your behalf and you have some sort of insurance obligation for that equipment or something that shows that you're on the hook for it. If it's really their equipment, you're not going to be able to include it.
Got it. Okay. Let's go through some forgiveness questions. Sarah, load up 13 and 14 because I'm going to actually skip 13. I've kind of already covered it. 14, using the baseline period for calculating FTEs of the first 2 months of 2020. I have one employee who started like the last week of February. Do I count them as an FTE?
Are you asking me? Because I'm going to say yes.
Yeah, absolutely. Yeah, we certainly do. They were an employee that you're going to get one, I think it was about 8.6 weeks in that time period. So you get one divided by 8.6, which works out to, we'll call it 0.1 FTEs, but that would be additive to your baseline.
And John, you're using a 40-hour week. We should also clarify that. It's a 40-hour week very clearly and not the ACA 30-hour week.
Correct. Good point. Okay, we pay twice monthly. So do I take this $100,000 cap and I divide by 12 and then again by 2 payrolls per month? No, that's not the right math. It's literally $100,000 divided by 52 and multiplied by 8. So 8 weeks worth of $100,000, 850 seconds is 15,385.
Yes,
okay.
And I'm going to interrupt you for a moment, John, on that. Many questions asked about how you calculate average FTE and average comp. You are going to end up doing weekly calculations because in order to compare a 3-month period to an 8-week period, there's no other math. You're going to have to get down to using weeks as your basis for measurement.
And here's the other good thing. You don't actually have to do the calculations because the model will do them for you. You just have to load in the pay. You don't even have to figure out is somebody over 100K. You just put in the amount they got paid and the model does all of that math. So you don't have to know all these calculations. We're just explaining them to you. Okay, we provide uniforms for our plan employees that we rent through a third party. Can we consider this like equipment rental so we can get forgiveness?
That's a no for me because it's not equipment rental.
Okay, fair enough. Sarah, let's skip 17 because the answer is basically no. 18, we file taxes as a C Corp. The owner does not go through payroll for their pay. Can we still include their pay in the cost?
No. In a C Corp environment, owners would be paid on payroll and would receive a W-2. And if they're not on a W-2, they're not included.
There you go. 19 is an easy one. Can I use the other 40% not used for payroll for things besides rent and utilities now that the rule has changed? And the answer is no, you cannot use it for other operating expenses. It's still the same 4 covered categories for forgiveness. There's a number of people that have gotten EIDL loans. Sarah, can you load 21 as well? These are both related to EIDL. Will the $10,000 grant that we got affect the forgiveness? And if we elect to take additional EIDL money, will that impact forgiveness?
The answer is no. You just can't use EIDL money for the same purposes that you use PPP money for. They're 2 different kinds of money. They work in harmony. They are not exclusive or harmful to each other.
Right, but the EIDL grant itself will actually be subtracted from the forgiveness amount.
Eventually, yes.
Yeah. And then the last question is the time to spend has been extended to the end of the year. Can we continue to cover payroll through the end of the year, or can we only cover 8 weeks of payroll? Actually, on this one, the time to spend has not been extended till December 31st. It's been extended to 24 weeks. It's December 31st if you got a PPP loan funded after, I think, July 15th or 16th, something like that. So it's actually 24 weeks, not to the end of the year, for virtually everyone that's on this call. And yes, you can continue to use the money to cover payroll through your covered period. It's not limited to just 8 weeks. Okay, it was a bit of a lightning round, and we've actually hit the end of our 90 minutes. So I think what we're going to do, because there was, as I said, literally hundreds of questions that have come in, we will go through those as best we can and begin to add those into the FAQ library here in the next couple of releases of the library. So please be on the lookout for that. Check often, and you'll be able to see very easily what's been added based on what's highlighted in red. Jen, thank you very much for all of your good input here today. Sarah, I know you want to take us out and talk about a survey that's coming up.
Yes, thank you so much, Jen and John, for the presentation. We will be sending out a survey. You will receive it either today or tomorrow. There are some questions asking you what did you think about the session today and what are some future topics you would like to look at. So please fill that and that will help us make our webinars better. And again, the deck and the recording link will be sent within 48 hours after the end of this webinar. Again, we really appreciate everyone joining us today, and thank you to our presenters.
Thanks, everybody.